Welcome to Watch to Get Rich, your guide to wealth and financial freedom. Ladies and gentlemen, if you're serious about growing your wealth, listen up. The year 2025 will be a turning point for many investors, and whether your assets grow or shrink will depend on global economic shifts, especially those influenced by the potential return of Donald Trump. In life, opportunities come and go, but right now we're witnessing a wave of unprecedented investment openings that could multiply your net worth exponentially. You don't need to work from dawn till dusk, nor do you have to save every penny. Instead, you should focus your financial resources on high-impact investments. Picture this. What if a new cryptocurrency backed by Trump skyrocketed overnight? Imagine seeing your wealth increase 200 times within hours, propelling you into the ranks of legendary investors, outperforming even Warren Buffett and the entire Wall Street elite. Sounds impossible? Let's take a look at the numbers. When we analyze the Trump family's wealth, we see that from his grandfather's generation, it took over 100 years and 3 generations to accumulate $6.5 billion. Yet in a single day, Trump reportedly secured $30 billion from a strategic investment. How? He capitalized on trends, market shifts, and global policies that favored his financial moves. Now the question is, will you position yourself to ride the next wave of wealth creation? The 4 major moves Trump will make and how they can double your wealth. Many people wonder, why are Americans choosing a businessman like Trump over politicians like Joe Biden or Kamala Harris? The answer is simple. The American people want a leader who runs the country like a successful corporation, prioritizing income growth, expense reduction, and financial stability. Trump, like any shrewd businessman, understands that to build wealth, you need to increase revenue, minimize debt, and manage assets efficiently. 1. Reducing America's global military expenditures. The United States has long played the role of global police, maintaining military bases across the world and intervening in conflicts that don't always directly impact American citizens. This has led to astronomical defense expenditures. Just in Afghanistan, the U.S. spent over $2 trillion. Such heavy spending has significantly contributed to America's growing national debt, which now exceeds $30 trillion. Trump's strategy is clear: reduce unnecessary military spending and reallocate resources to strengthen domestic investments. One of his core policies is to demand that U.S. allies, such as Germany, Japan, and South Korea, contribute more to their own defense. If these nations refuse to increase their military spending or pay the U.S. for continued protection, Trump has indicated that he will withdraw American forces. This move would significantly cut down on U.S. expenditures, easing the financial burden on taxpayers and freeing up billions of dollars for infrastructure and economic development. Historical precedent. During Trump's first presidency, he negotiated increased defense contributions from NATO allies, arguing that the U.S. should not bear the majority of defense costs, while other nations enjoy security without significant financial contributions. His administration successfully pressured European allies to increase their defense budgets, ultimately reducing America's out-of-pocket military expenses. Investment implications. If Trump returns to office and follows through with his military expenditure cuts, it could have significant effects on the economy and investment markets. Defense contractors like Lockheed Martin and Boeing might experience volatility, while sectors benefiting from redirected government funds, such as infrastructure, energy, and technology, could see substantial growth. Investors who anticipate these shifts and reposition their portfolios accordingly could see immense gains. Real-world example. When the U.S. began withdrawing troops from Afghanistan, defense spending was reallocated to domestic projects, infrastructure, and innovation. Savvy investors who understood these shifts moved their funds into industries that benefited from the redirection of government resources, such as cybersecurity and manufacturing, leading to significant profits. By cutting down on unnecessary military engagements and focusing on economic growth at home, Trump's strategy could create new investment opportunities for those who recognize the shifts in government spending. 2. Increasing U.S. revenue. Through global tariffs, Trump's economic philosophy is centered around the idea that America should no longer be the world's financial crutch. His administration previously imposed tariffs on imported goods from China, the European Union, and other countries, compelling foreign businesses to pay the U.S. government a premium for access to the American market. His argument? These nations have long benefited from U.S. economic strength while offering little in return. By enforcing tariffs, Trump aims to generate additional revenue streams for the United States without increasing the tax burden on American citizens. Historical precedent. During Trump's first term, he launched a trade war with China by imposing tariffs on billions of dollars worth of Chinese goods. China retaliated with its own tariffs, but ultimately, U.S. businesses adapted, and certain industries, particularly domestic manufacturing, benefited from reduced dependency on Chinese suppliers. Companies such as Apple and Tesla made significant shifts in their supply chains, diversifying away from China and into regions like India and Mexico. Investment implications. Investors who anticipate shifts in global trade policies can position themselves accordingly. When tariffs are imposed, companies that manufacture within the U.S. become more competitive. This was evident when steel and aluminum tariffs led to increased domestic production, benefiting companies like U.S. Steel and Nucor. If Trump reinstates or expands tariffs, similar opportunities could emerge in industries like automotive manufacturing, technology, and energy. Real-world example. Consider the impact of the tariffs on American farmers. Initially, the retaliatory tariffs from China led to short-term losses for U.S. soybean exporters. However, the U.S. government provided subsidies to offset those losses, and many farmers ultimately found new markets in Europe and Latin America. Investors who recognized these shifts and backed companies involved in alternative agricultural exports saw significant returns. Future outlook. If Trump returns to office and strengthens tariffs on foreign imports, expect a renewed push for domestic manufacturing, supply chain diversification, and increased revenue for the U.S. government. Industries that align with this shift, such as logistics, raw materials, and industrial automation, are likely to thrive. Investors should stay informed and be ready to pivot as these economic policies unfold. 3. Expanding U.S. asset control. The Canada and Greenland factor. Trump has always viewed geopolitics through the lens of business expansion. One of his most ambitious goals is to strengthen U.S. asset control by extending its influence over resource-rich territories, such as Canada and Greenland. The logic is straightforward. By gaining greater access to these regions' resources, the U.S. can dramatically increase its asset base, which in turn can help back the national debt and bolster economic stability. Canada, the undervalued economic ally. Canada is one of the richest countries in the world in terms of natural resources, with vast reserves of oil, timber, fresh water, and minerals. Given its proximity and deep economic ties with the U.S., Canada is often seen as an economic extension of America. Trump has long proposed that Canada should become more integrated with the U.S. economy, possibly even making it the 51st state in a hypothetical scenario. While this may sound extreme, it underscores his belief that the U.S. should leverage its neighboring allies' resources more effectively. If such integration were to take place, it would mean massive economic benefits for the U.S. The ability to extract and refine Canadian oil without trade restrictions could lead to greater energy independence. Moreover, access to Canada's mining resources could further strengthen the U.S. manufacturing sector, creating new investment opportunities in infrastructure, technology, and industrial commodities. Greenland, a strategic resource hub. Greenland is a lesser-known but highly valuable target in Trump's asset control strategy. The island, which is technically owned by Denmark, is home to vast reserves of rare earth minerals, oil, and other untapped resources. Trump previously made headlines by suggesting that the U.S. should buy Greenland, a proposal that Denmark rejected at the time. However, the logic behind this move was sound. With China dominating the global rare earth market, securing Greenland's mineral wealth would allow the U.S. to reduce dependence on foreign suppliers and maintain a technological advantage in industries like defense, aerospace, and electronics. Given the increasing geopolitical tensions and global supply chain disruptions, control over Greenland's resources could be a game changer. Investment implications. If Trump or a similarly business-minded administration pursues policies that bring Canada and Greenland closer to the U.S. economic sphere. Investors should look at industries that stand to benefit the most. Energy and mining, companies involved in oil extraction, lithium mining, and rare earth processing will likely see significant growth. Investors should watch for U.S. firms expanding their operations into these territories. Infrastructure development, increased economic integration would require large-scale projects, including roads, pipelines, and ports, benefiting construction and logistics companies. Technology and defense. Given the strategic importance of rare earth minerals, firms specializing in electronics, semiconductors, and military technology could see a surge in government contracts and private investments. Future outlook. If Trump regains power and revisits his plans for Canada and Greenland, expect policy shifts that favor U.S. dominance in these regions. While a full acquisition is unlikely, closer economic integration could still yield massive benefits. Investors who position themselves early in resource extraction, logistics, and defense industries could see unparalleled returns. Controlling the energy market, the Gulf of Mexico and Panama Canal strategy. Trump's strategy for dominating the global energy market revolves around two key areas, the Gulf of Mexico and the Panama Canal. Both regions are central to U.S. energy independence and economic influence. By strengthening control over these territories, the United States can secure its energy needs while leveraging trade advantages that other nations cannot ignore. The Gulf of Mexico, America's energy hub. The Gulf of Mexico is one of the richest energy-producing regions in the world, housing vast oil reserves and critical refineries that power the U.S. economy. Trump's focus has been on increasing domestic oil production while ensuring that foreign competitors have limited access to these resources. During his previous term, Trump deregulated offshore drilling and opened up more areas for energy exploration. If he returns to office, we can expect a renewed push to extract more oil from the Gulf, potentially reducing America's dependence on foreign oil. Increased drilling could lead to lower gas prices and a more stable energy market, benefiting both consumers and investors. The Panama Canal, a strategic trade route. The Panama Canal is a crucial passage for global trade, particularly for energy exports. Control over this waterway allows the U.S. to regulate oil shipments, influence global pricing, and strategically limit competitors' access to markets. Trump has previously expressed interest in exerting greater influence over trade routes like the Panama Canal to ensure American dominance in international commerce. A stronger U.S. presence in Panama could lead to increased revenues from trade tariffs and control over fuel shipments passing through the region. By implementing tariffs or restrictions on competitors, Trump could ensure that the U.S. remains the preferred supplier of oil and gas, further boosting domestic production and economic growth. Investment implications. Investors who understand the significance of these strategic moves can benefit in several ways. Oil and gas industry. Increased offshore drilling will likely boost companies involved in oil exploration, extraction, and refining. Look at stocks from companies like ExxonMobil and Chevron. Shipping and logistics. Control over the Panama Canal could impact global trade logistics, benefiting companies that manage shipping routes and energy transportation. Infrastructure development. Expanding America's energy footprint will require investment in pipelines, ports, and refining facilities, creating opportunities in construction and industrial sectors. Future outlook. If Trump implements these policies, the U.S. could become an even stronger player in the global energy market. Investors who anticipate these shifts and position themselves accordingly could see significant gains as oil, shipping, and infrastructure industries expand. What this means for your investment strategy. With these strategic moves, Trump's financial game plan revolves around increasing U.S. assets while reducing liabilities. If you understand how to navigate these shifts, you can position yourself to capitalize on market movements. Real estate and financial markets, a potential collapse and buying opportunity. One of the most controversial proposals is Trump's potential privatization of Fannie Mae and Freddie Mac, two major mortgage backers. If this happens, the government will no longer guarantee home loans, potentially leading to higher mortgage rates and a real estate market correction. Lessons from 2008. When the real estate bubble burst, properties were sold at rock-bottom prices. Investors like Warren Buffett capitalized on the crash, purchasing assets that later appreciated significantly. If another correction occurs, those with liquidity will have the buying opportunity of a lifetime. How to prepare yourself. Diversify your investments. Look beyond stocks. Real estate, commodities, and foreign markets could offer opportunities. Stay ahead of policy changes. Government actions will shape the market. Keep informed and act before the crowd. Be liquid. Cash reserves will allow you to seize opportunities when assets are undervalued. Final thoughts. The next big opportunity is here. Are you ready? Economic shifts are inevitable, but those who prepare can turn uncertainty into fortune. The coming years will separate those who understand market trends from those who blindly follow the herd. Whether it's cryptocurrency, real estate, energy, or tech investments, opportunities are waiting. Subscribe to Watch to Get Rich and stay ahead of the curve. Turn knowledge into profit, and let's build wealth together.